So it is my pleasure now to invite the esteemed panel onto the stage for this session. The session will be moderated by Ms. Shweta Shah, co-founder and director, Silver Compass Capital. May I request her to please join us on stage. The esteemed panelists for this session are Mr. Aditya B. Chatterjee, Managing Director, Equifax Credit Information Services Private Limited. Ms. Aishwarya Ravi, Chief Financial Officer, Kinara Capital. Ms. Pallavi Srivastava, Co-founder and Director, ProgCap. Mr. Sanjay Sharma, Managing Director, iFinance. Mr. Ankur Bansal, Managing Director, Black Soil Private Limited. May I request them all to please join us on stage. So we look forward to a very insightful discussion. With that, I hand it over, the charge of this session, to Shweta. It's over to you, Shweta.
Yeah. Thanks. Good afternoon, everyone. I hope you've all had a delightful lunch and are ready for what promises to be a very insightful and engaging discussion. It's an honor to welcome you all to this session on unlocking MSE financing for sustained economic growth. As we all know, micro and small enterprises, MSEs, are the backbone of our economy, contributing to about 30% of the GDP. Also, they are pivotal in creating jobs, employing over 110 million people across the country. Yet, despite their pivotal role, they face challenges that often make the growth look like climbing a mountain. The gap in this particular space is estimated to be about 20 to 25 trillion rupees. Many MSIs rely on informal channels for credit, often at significantly high interest rates due to limited access to formal credit. I'm Shweta Shah, co-founder of Silver Compass Capital, an investment banking firm with a dedicated focus on impact finance. At Silver Compass, we bridge the gap between entities seeking funding and impact investors who are committed to creating meaningful social and economic change. I will be the moderator for this session. Before we dive into this discussion, let me introduce our distinguished panel. I promise they will be providing more than just the advice and bring their different perspectives on this in this discussion. As I look at this panel, we have 3 gentlemen and 3 women, a perfect balance. After all, innovation thrives in diversity. We have with us Ms. Aishwarya Ravi, CFO of Kinara Capital. We have Mr. Aditya Chatterjee with us, Managing Director of Equifax Credit Services. We have Ms. Pallavi Srivastava, co-founder and director of ProgCap, Mr. Sanjay Sharma, managing director of iFinance, and Mr. Ankur Bansal, managing director of Black Soil Private Limited. Thank you all for joining us, and let's begin with our discussion. My first question is to you, Pallavi. What do you see as the primary barrier preventing MSEs in India from accessing affordable and timely credit? Are these challenges more structural in nature, or you feel they are more operational in nature?
So, like you rightly highlighted, 90% businesses are small and medium enterprises. Interestingly, 90% of them don't have access to credit. So it's a large problem spanning millions of MSMEs, and therefore the solutions need to be also scalable. Now, with this wide gap that you spoke about, trillions of rupees, we have the numbers with us, $150 billion of credit gap in India alone when it comes to retail economy, and then overall it's close to $530 billion. So very, very wide gap when it comes to SME lending, and various challenges both from the structural side and the operational side, but I would like to split it more into supply side and demand side challenges. Supply side challenges we are all very aware of. We know that banks are not able to lend to these customers because they don't have the bureau data, they don't have the credit footprint, and it's a vicious cycle of just getting started with the first credit, right? even if banks want to go ahead and lend, they need, if not for the bureau record, some kind of an alternate data, which is not available because they are non-digital, they are informal in nature. So that's a broader problem. If we find an alternate way to lend to them, there is a challenge of collateral because they have minimal asset, minimal capital to place as collateral. So these are the challenges we know, where the moment you go to tier 2, tier 3 towns, you will find that this becomes multifold. Alternate ways of lending also become a challenge because the economics don't make sense for small ticket size to incur such a high processing cost. But the bigger challenges that we encountered, because we lend to very different segment, which is the shopkeeper trading MSMEs, which constitute 30% of the 63 million MSMEs that we speak about, we found the demand side challenges more prevalent. So let's say we find a way to be able to find an alternate data to lend to these customers. We are able to find a way to reduce the cost and do it in a more technology first way. Our biggest barrier was that the customers who are a part of informal way of working had a big switching behavior inertia. So they would want to continue with informal ways because there is some kind of a informal credit prevalent. How do you break that? So it's just not a challenge of banks and fintechs being able to reach out and find ways to lend and plug them into the formal economy. It's also a challenge of inertia emerging from two things. One, of course, now you need to get into proper repayment behavior, because now if you don't pay in time, it will get reported into CIBIL. So, the shopkeeper segment, if I speak about, is dependent on distributor credit, which is informal. So they are many times comfortable with this informal credit economy. So that's one challenge when you think about servicing this segment. The other one is, often we are trying to solve the problem of short-term working capital with a long-term product. So you may need a working capital credit of 60 days, 90 days, but we are trying to give them long-term term loans of 2 years, 3 years, which does not match with the cash flows and therefore does not serve the customer. So these are the broad spectrum of challenges that we see, and as we think about solving them, the focus has to be thinking holistically about how these businesses work, how they behave, how they work with their ecosystem partners, how the trade works, right? So, and then think about not only the underwriting and risk assessment and profiling, but also thinking about how do we solve it with the right product and build controls so they are able to repay in time. And after getting credit, they are also equipped to repay and get into a formal credit. So formalization and digitization is the way to go to be able to address this large-scale challenge, which is beyond data, beyond bureau. And once it is done, then it's a spiral and shifts the orbit for the ecosystem.
Thanks, Pallavi, for that insight. And I think you covered very well in terms of demand and supply side challenges. Ankur, just adding to what Pallavi said, you also at Black Soil deal with a lot of MSMEs, and you've had experience of dealing with a lot of them. In your own experience, are there any other unique challenges that you want to highlight? Any barriers that comes to your mind?
So the barrier at the MSME level is quite clear. I put it from the supply of capital perspective. Today, when there is banks and NBFC sitting, they already have a lot of demand for credit, right? Our country is always looking for credit. So they have to go from the risk perspective. The risk appetite for our MSME space is very limited. Everybody wants to work with a high quality customer base, right? So for example, in PropCap's case, supply chain finance also banks do. So then there is a PropCap fitting into the business, right? Because they are going down the risk where a bank is not comfortable, but there is certain kind of underwriting tools or collection, etc., has been built around to be able to serve that MSME customer. But this is where all these fintechs sort of started coming into the picture in the last 10 years, right? Where we saw a large opportunity that, they are not being able to serve traditional banks and BFCs, and we can start these fintechs and use the digital route to reach out to these MSMEs, do all this alternate data. But that also we realize has not worked out completely, right? Because the NPAs has been through the roof, and without that physical presence, there has again become a challenge. So now the new source of companies that we are seeing at Black Soil are the physical plus digital companies, where they want to have the digital presence because they start from scratch, so they don't have the legacy systems, so they can do underwriting on the go, but at the same time have physical branches, so the touch and feel of the customer is very, very critical, right? So there is going to be a lot of changes over a period of time. The cohort of companies are changing. Everybody realizes that technology cannot be ignored, right? So that's what banks are also changing. I'd say the first wave was the co-lending. Co-lending opened up a very huge supply of capital for fintechs, and that also helped us to sort of be able to go deeper into the markets. So there is a lot of things happening now across various businesses. If you are building a strong business with a strong underwriting channel, a lot of capital is sitting. If you are able to show the cohort of low NPAs, good collections, and all the MSME customers can be taken into account, right? So like today, if you meet a bank CEO, or even if you meet the top bank guys, the first thing they tell me, we have a very good tech stack. Why don't you integrate with us? Which is not the case. Nobody would talk about technology as a bank, right? Because they also realize now tech is just an enabler. The real business is of underwriting and collections, right? So that cannot be completely ignored. So all these benefits will start going to deeper into the, into the country, right? So I would say earlier tier one cities was the maximum focus of fintechs. Now we are seeing more tier two, tier three, tier four cities where fintechs are penetrating. And maybe that is also one of the reasons why we are a certain problem right now, because a lot of unsecured PL has reached a microfinance customer. That's what I keep hearing from the market. So, but that is, there is this excesses and lows that we have to go through as an overall business.
Thank you, Ankur. I think you beautifully explained the amalgamation of physical and digital presence, and which is very, very important. You spoke about technology. We'll come to that a bit later. Aishwarya, my next question is to you. Government has come out with multiple initiatives, in this space, specifically CGT, MSE, PMMY, Stand Up India. How effective are these measures for bridging the credit gap in MSEs according to you? And is there something more that can be done in this space?
Yeah, a very interesting question. Government has, for the past several years, come up with different schemes depending on what the ecosystem is in need of. And as you mentioned, PMMY, the credit guarantee schemes and the Stand Up Loan India schemes are quite one of the few where at least we have seen traction in terms of how they've been able to enable credit. So if you look at the PMMY scheme, it's been running for several years, and I'm told that they've been able to fund close to $388 billion under the scheme alone in the last so many years, which primarily has been focused on the micro and small scale borrowers, but at a very low ticket size of about 52,000 odd crores. But what's interesting there is the fact that they've also been focused on women. So about 62% has gone to women under these schemes, which is the driving focus of one of the overall architecture on which the government is trying to fund these micro enterprises. I mean, at the end of the day, MSMEs form the backbone of our GDP, and I think it's very important from the government's point of view to promote it through different schemes, which is scalable and which is accessible. So, in terms of the credit guarantee scheme, just on the CGT MSE front, there's been significant momentum in the last few years. Just in FY24, almost $18 billion trust on loans have been given under the scheme, which is almost a 50% uptick from 2023. So I do strongly believe that all of these schemes have increased in volume and scale and is trying to reach the right target audience. But having said that, there are also structural limitations and challenges what we see. Fundamentally, the first sort of challenge is, are people even aware of these schemes? What is the way they get to be aware of it, number one? And how do they take benefit of these schemes? For example, the credit guarantee scheme can be deployed only through a financial institution, maybe NBFC or the bank, right? So how do we evangelize this to the NBFCs or the banks that getting party under the scheme will help them probably lend more to this customer base than what is usual, or at least have a measure of protection so that they are able to fund these excluded sectors, which in the normal course of business may not make a business reality. So structurally, I still think there's a lot of work which can be done, and it needs to be co-piloted between the government and the practitioners or the financial institutions so that this reaches the right target audience. So that's number one. Number two, evangelization workshops to conduct awareness of these schemes at the ground level, at the business enterprise levels, will go a long way in making this a demand from the supply side, and hence this will automatically sort of start showing results. And the other sort of framework around these policies, right, is something where the government have, in my opinion, not very clear guidelines are there. So a lot of clarity on the guidelines of how this will be implemented, what is the longevity of these schemes, and what is the expectation of how the schemes will be promoted at the ground level, will also help us in identifying the right population and hence funding the unfunded in a better way.
Right. Thanks, Aishwarya. My next question is for you, Mr. Sanjay Sharma. I'm sure at iFinance you've tried innovative methods of solving one major problem which has been a long-standing issue in this space, which is high collateral requirements from the financial institutions. Now, typically the MSE customers would not have the high collaterals available at their disposal. As an lending institution, are there any innovative methods, any alternative credit assessment solutions that you think can be helpful in tackling this particular challenge?
Thank you. Good afternoon, everyone. And it's a very interesting question to ask that how do you handle a request for a non-collateralized loan, especially in a segment which itself is very difficult to establish anything but the KYC of the customer. And before I answer that, just a small thought that while a lot has been done in the development of the micro-scale MSMEs and the small-scale MSMEs and lending to them, but a lot still remains to be done. So it's whether you call it glass 1/3 full and glass 2/3 empty, it's your call. But there is a lot more that needs to be done. And when I say a lot has been done, just imagine that 10 or 15 years back, when there was no Aadhaar, even PAN card was very rare, you won't even be able to establish the identity of the person, first of all, the business owner. At least we have solved that problem, and at good scale. Transactions have become far more easy to trace through digital UPIs, etc. But still, the key problem of how do you underwrite a customer, especially when you don't have the support of a property as a collateral. And second is, how do you establish that it's not a fraudulent enterprise? Now, you may say that Udyam has come in, and Udyam allows you to register an enterprise. But actually speaking, if you wanted to register a fictitious enterprise, you could do that on Udyam database. All it asks you is for a KYC document. So Udyam also solves only for the KYC part of the problem. Now, in this scenario, when someone comes and says that I want a loan and I cannot give you a property collateral, it would make any banker or any financier fidget a little bit, because when we started iFinance, when I started iFinance 10 years back, when we went into a new town, the landlord who gave us the branch premises always said, "Yahan pe paise mat dena, you will never get your money back." That was his wise suggestion. And so even the local segment does not feel that this space is creditworthy. But if you go into the markets and ask them that what is it that you need, we have found through our own internal research that 9 customers out of 10 in the micro enterprise space want a non-collateralized loan. And when I say non-collateralized, I mean without a property involved. Fine. The 2 big things they ask, one is don't ask me for property, and the second is don't ask me for a guarantor. So I think, but this problem has to be solved, because otherwise 9 out of 10 customers, you would not be able to address. When you look at data, and you have a lot of data from credit bureaus, you'll find that the property-based lending and non-property-based lending is roughly 50-50. But the reason the non-property-based lending is 50-50 is because no one has offered them the supply. Otherwise, it would have been 90-10. And in iFinance, 90% of our loans are loans without property. So we have experimented in this area. We have had some good experience. Gross NPAs are very well managed. And the way out of that is to make sure that there is a phygital approach, there's an actual branch presence so that we can weed out the possible operational risk or frauds. We can make sure that the business does exist. It looks like a well-run business. And then we use certain cluster-based markers or surrogate data, you could call it, to assess or estimate the income. As we have gone along, that estimation has become better and better. As we have gone along, we have started using machine learning models to estimate in some segments where we have large number of data points. So we are also gradually moving, and I think in these 10 years, we have given almost close to 10 lakh loans. So it is scaling up. But when you look at the 60 crore micro enterprises that are talked about, 10 lakhs is hardly a scratch. So again, saying that a lot needs to be done, and a lot needs to be done in the non-collateralized space because that's what the customer really wants. I think.
Right.
Thank you.
Thank you, Mr. Sharma. Aditya, my next question is for you, and I think you're the best person here on this panel to answer this. In terms of bridging this gap in MSME financing, what role you think credit information services companies like Equifax play by using data analytics, credit scoring methods, especially how do you deal with it when it comes to customers who don't have prior credit history? If you can throw some light on these points, yeah.
Sure. Thanks, Shweta. And good afternoon, everyone. So just taking a step back, all the bureaus actually operate three different bureaus, so to speak. One is the commercial, which is the pure, I can say a bit large cap kind of lending happening through proprietorship firms. Second is the retail, which is you and me. And third is the MFI. So there are three very distinct sets of bureaus that is getting operated. And I make this point because something like an MSME lending, the footprint can be found in all the three different bureaus if seen with a consolidated view. For example, it could be a firm taking a loan. However, the proprietor could be having a long-standing retail presence. Or if you're looking at the bottom of the pyramid, the female entrepreneur could be having an MFI linkage, graduating to retail as well. So the point I'm trying to make is that I think one need of the hour is that if we are looking at the bureaus independently, the NTC kinds of rises. But what I think everybody is working on and the products are also there is a consolidated view across all three bureaus. So I think that is the first thing that will, that is the data we already have. We don't have to reinvent the wheel for that. That's point number one. Second is that I think a much deeper analysis is required and that we are doing of what the segment that we call as the business loan unsecured between 1 to 5 lakhs. Right? Because there we are seeing an amalgamation of a lot of MSME loans, a lot of MFI is coming into a business loan unsecured, 1 to 5 lakhs. There's a lot of firms taking a loan. So in a market that we know is already heated, has some of its challenges, this segment actually is growing by leaps and bounds. And hence, as a bureau, we are looking into it that why is this growing so much and can we kind of get some, method in all the chaos. My third point is that, Sanjay ji referred to Udyam. So the bureaus are only as good as the data that is submitted to them by the financial institutions, right? Because there are huge restrictions on us going outside and acquiring data. RBI doesn't like that. So if we get cohorts like Udyam, right, if the submissions can have the Udyam number, A lot has been spoken about Aadhaar, so I won't go in the whole Aadhaar thing, but we know how that would help in NTC. That's a no-brainer. But if at least in the submissions, the Udyam number keeps coming to us, then we can make cohorts, we can do analytics and a lot with it. So the last point mine was regarding to the PII that, Udyam number or an Aadhaar, that would help us a lot to help the financial institutions identify and underwrite NTC.
Thanks, Aditya. Moving on, I think, Pallavi, I have the next question for you, and this is to do with financial literacy. So it's been observed over so many years that MSEs specifically have very limited financial literacy, which actually creates a lot of issues, not only for them to access credit, but also managing credit once they avail the same. According to you, are there any ways of enhancing financial literacy? Is there something that can be done at the ground level? Just want to know your thoughts on this. Yeah.
Sure. So I think SME credit is all about SME financial literacy. And I always say this, that knowledge here is the best form of collateral. And so I'll just take a step back on exactly what we do as a company. So we are into supply chain finance, and we provide credit to last mile shopkeepers. We tie up with a brand, let's say Unilever or a Samsung, and we'll fund their downstream supply chains. We don't take any form of collateral. Instead, it's an unsecured lending, but what we have is a risk incentive and trust-based, transaction incentive-based model between the anchor, the wholesaler distributor in between, and the end shopkeeper, who is the borrower on record. So when the borrower buys goods from the wholesaler, he is able to get instant credit because we pay on his behalf to his principal supplier. And then as he is able to make sale and he is able to realize cash, he pays us back, right? So one of the things very important here, and I just brushed upon it in the challenges question, is that digitization and formalization of the business is key to accessing credit for SMEs. If these businesses are formal, they are digital, they would have lots of opportunities for banks and traditional financial institutions also to lend to them. So that has to be solved first. And one of the ways we do this is by incentivizing good repayment behavior. So as you can think, a shop is running, there is footfall, there are customers coming, he's selling something every day. Let's say it's a home appliances shop. So every day there is some kind of a sale happening. We encourage customers not to wait for the entire tenure of 90 days, 60 days, but make early part payments. Why it is important is because we are inculcating and training them on good repayment behavior. We also onboard the entire supply chain. So we would have the anchor partner, we would have the middlemen, the intermediaries, who were all working, by the way, informally so far. So, and the end shopkeeper, they will all come on the platform, and all the transactions will happen on the platform, and we fund those transactions. What that leads to is that beyond credit, we are also digitizing these supply chains, which were working informally. So, I remember 2017, 18, when I would go in the market, we would see that, the supplier or wholesaler would come to the shop of a retailer. As per his beat plan, the salesperson will come and he will get one paper, a booklet, and he'll take the order. Ki itna pankha hai, itna light hai, right? So whatever is the product that is to be sold. And then he will take the order. On the other side, he will take the check. So by giving credit, you have digitized the check transaction. Of course, some part of it is already digitized with an NEFT, etc. But you are now training them to make digital payments using UPI on the app. So of course, all this digital infrastructure has been a big enabler. But the other side, where he's now taking orders on paper, if you digitize that also, the goods are flowing through you. So it requires a complete embedded credit journey. And that is the kind of training where these customers who are used to doing kacha and working outside, it has to come. Now GSTN coming has been a big enabler, not only for us, but for a lot of other lending businesses. You have formal data available, which can be verified. So some of these are very important enablers. The other incentive is when you pay early, you are able to get early payment discounts, right? You get often they think that my informal credit, which I get from my wholesaler, is effectively zero ROI for me. It's interest free. But if you look at it, they always have early payment discounts built that if you pay me on day 1, day 5, day 7, you will get some kind of a extra margin, which they leave on the table. So now they're able to avail that. So a lot of it is also helping them to understand. And it's just not about that you should pay in time, that then you will get better quality credit, you will get less ROI. It's not just about training on credit, but also training on how to run their businesses effectively, right? How they should do the filing properly. We have a huge focus on every loan, and it's not a requirement, but we always get Udyam registration done for them. Simply because then that helps them to avail a lot of other benefits. It helps us because now it gets tagged under priority sector lending, which is the only way for trading SMEs to be tagged as PSL. So some of these things, we are doing. You don't have a choice. You can't just give money and hope and pray that these customers who are used to working in informal way will pay in time. So you got to have a lot of interventions. We have a calling team which constantly make sure that they are repaying in time, they're repaying in part, not waiting for the last day, so fund diversion does not happen. So these are some of the ways, and I think, as we empower, as we build more knowledge, we just don't have a good borrower as a customer, but we have a very high quality business, which has an impact on, it not only thrives, but also it supports to grow the economy further.
All right. Wonderful, Pallavi. I think you've touched upon multiple aspects, and I think the key takeaway from whatever you spoke, I think there are few things which one needs to keep in mind. Firstly, empowering customers for more digitization and throughout their entire business cycle, and being constantly in touch with your customers. I think that's also something which you've highlighted is an important part. Ankur, from your experience, of dealing with these type of customers, any other thoughts that you would like to add in terms of adding to the financial literacy of the customers?
So before this panel, I was just asked my team to just check out what our fintech companies and other clients are doing. And I was surprised that out of the 10 companies that they sort of did a sample search, all of them had their own financial literacy program. So this is them being, on the right side of things, making the customer aware what the product is, how it goes about it. And I think that communication to the client continuously is the way to go. Whether you're a large bank or a small NBFC, I think you need to explain to them what this product means, how are the positive, negatives, etc. about it. I'll give you one very different example, which just came to my mind when we were talking about it. One fintech company told us that they are giving solutions to their NPA clients, that you come and settle. Instead of just calling them continuously, you have to pay. The app itself gives a notification that if you want to pay it off, the 20% haircut, 30% haircut, these are the 2-3 schemes, select, close it, and this is the benefit of it. So I'm saying sometimes you need to do a little bit of innovation about how do you go about explaining, because this will be better for you instead of getting the default going on. So many companies have their own ways of going about it. Sometimes a concerted effort is required maybe at the ecosystem level, but it's a lot of information to the customers are aware of. Like I hear in microfinance, the customer will tell, please ensure that my khate mein dal doge aapki ye maine payment ki hai. So all these learnings, the customer is also aware. So it's not that they're not aware of it. Of course, there can always be frauds, etc. happening, but on an overall period, we see that this technology, digitization, using in the right way, which is what the regulator is also looking for, can help us build a very positive, credit, vibrant economy.
Great. Thanks, Ankur, for sharing your personal experiences with us. Next question, moving on to Aishwarya. Aishwarya, women-led MSEs often face greater challenges for accessing finance. What are the few things that can be done to make MSE financing more equitable, more inclusive? Any thoughts?
Yeah, sure. I think historically, India has faced a challenge with women across multiple levels, not only businesses, but on the professional side of things as well, in terms of where we are able to lend access to women. And specifically for the MSME population, what we see is less than 20% of enterprises are women owned, which is very low, considering that women form 50% of the population. That's a very low representation. And I think Pallavi did mention the overall credit gap, which is almost at $530 billion across the segment. 40%, upward of 40% of the credit gap is contributed by the same women population who are less than 20% owning these enterprises, which goes to show that there is a lot of misses in terms of our ability to access women. So just from personal experience at Kenara Capital, what we've been doing for the last, I think, 4-5 years now is to try and engage with women at different levels, at the borrower level, at the business enterprise level, to try and understand what are their shortcomings, what is the main reason why they are unable to access credit. Fortunately, we've been able to fund almost to the tune of 800 odd crores just to women borrowers in the last few years. But what comes out from all of these interactions are the fundamental factors. Number one, most of the business ownership is divided among men and women, and it's mostly the women on paper and the men running the business enterprises. And hence, that's one of the major challenge what we see. Second, in terms of property ownership, women do not have a huge amount of land or property to sort of collateralize, and hence non-collateralized lending is the only sort of way for them to access credit, which again has its own pitfalls because you don't have a credit history, and hence how do you underwrite with sort of alternate data points to give credit to these women borrowers. And the third sort of more qualitative reason what came out from our interactions with the women borrowers for the fact that it's very easy for men to network, whereas for women, they are not great networkers, or they're not tuned naturally to be very easily network community, which is very essential for creation of a business and for scaling it up, which we try to sort of plug those gaps through a lot of workshops, focused exploratory programs for women so that they can learn it. But at a mass level, at an ecosystem level, I think there is a real need of how we can focus these efforts to women so that access to credit at least is something which they look forward to and they can sort of get it. On the financial institution side, what ideally we believe is there should be no disparity between credit assessment. Credit assessment should be based on the business's ability to repay the loan and not whether the show is run by a man or a woman. And hence, at least from our perspective, we've done data models, and I think most of the other financial institutions now do this, that the data underwriting is agnostic of male and female, and hence, how do you be fairer in terms of underwriting a potential customer regardless of their gender. Another good sort of initiative from some focus groups from the government to create policies around limitations for women or clear-cut identification of funds for women-owned enterprises will go a long way in trying to bridge that credit gap. The orange bonds in the last few years and a lot of focused liability funding for women-based enterprises has definitely helped to meet some of them. But I think at a larger level, we do need to have a rethink about focused products for women from the government.
Right, Aishwarya. Thank you so much, Aishwarya, for highlighting certain specific issues for the women-led MSEs. Moving forward, Mr. Sharma, the next question is for you, sir. Basically, I want to discuss a little bit beyond financing. While we all understand that access to credit is very important, but there are times when these MSEs also require additional support in terms of business development or market linkages. Are there ways in which financial institutions or ecosystem enablers, policymakers can help in these areas other than just providing credit?
Sure. I think Pallavi mentioned that one of the purposes of this inclusive finance that we are all into is to create vibrant and solid organizations who are very good businesses. And I think the businesses, as Shweta you rightly indicated, it's not just funding that is necessary, but there is something beyond funds. And typically for these very small businesses or unorganized businesses, how they market their products, in the sense that do they sell it in the local market or can they sell it to the actual main market where the buyers are? So how to market. Second is that how do they improve the quality of what they produce? And improving the quality is something that they have probably not given too much of attention to, because India is such a large market where anything that they produce gets sold. And I think that's one of the problems why the quality of what we produce has remained at a very poor level. And I think if we want to be a country like China, where the quality of production has improved consistently, then we need to get people to understand that quality of what they produce is important and what brings quality to their product. So two things that I would mention: how to improve the quality of what they do and how to market themselves, market their products better. And while we can keep talking of what can be done, but I want to give you a couple of quick examples on what we have done. In iFinance, we have a CSR wing, which today has almost close to 1.5 lakh plus beneficiaries. And this is exactly what they do. They try to create a skill uplift whereby someone who's manufacturing footballs, let's say in Meerut, starts, instead of getting 30 rupees for stitching the football, starts getting 70 rupees or 90 rupees. Right? And by training them, getting better instructors, showing them how exactly things should be done. We have seen a set of women from a minority community near Agra being shown how exactly to stitch a shoe and how to make a shoe. And some of them have started now producing shoes which can be sold in the market. So these are things that can be done, but it needs a lot of ground level effort and a lot of hard work. There are lots of government entities which are so-called supposed to help on this ground effort. And I think we need to really mobilize them better to make these things happen, to how to improve the quality of what is being produced, and to make market linkages better. And many of the technology tools that were mentioned will help in the supply chains, etc. So I think that is going to be something that can be done beyond finance to help these businesses get better.
Thank you, Mr. Sharma. It's really heartening to know that iFinance is taking these proactive steps and going beyond just looking at the credit. Moving on to the next question, Aditya, my next question is for you. I would like to know a little more specific in terms of, if at all, Equifax is trying to build some specialized tools or models which can help lenders to potentially assess the creditworthiness of customers, and especially in rural areas.
Sure. So we can logically divide this into two components. One is what more can be built with the Bureau variables itself. That is what we get from the credit institutions. And second is what can be built taking in external variables like payment data or utility data. So I will focus on the first part because, you know, a lot has been said probably about the second. Of course, I mean, it's a no-brainer of utility or payments or other such things. I mean, however, in real life, when we try it, we realize that it is not that simple. Marrying these two data sets, obtaining these data sets, maybe even telecom is not so easy. I mean, there are nuances. But focusing on the first part, that is within a bureau, there itself is a lot of things that can be used for women, for bottom of the pyramid, for rural, whichever way you want to define it. The first thing is that the bureaus actually have a MFI score as well. However, the reality is the retail score is much more used than the MFI score. So a score already exists for the MFI segment, which is totally different from the retail in the way of the build, the bureau, everything. So the basics exist, right? On top of the score, what we are also doing is building trended variables, right? So as we keep saying, if a person is 800 It's also important to know whether he came from 820 to 800 or he came from 750 to 800, right? Because the score by itself is a very point in time, right? But how the score is trending. I just gave an example of the score trending, but there are so many parameters that could trend in terms of exposure to secured loans, exposure to unsecured loans. The trending time period itself could be 6, 12, 18, 24 months, etc. Right? So overall, the trending attributes are so very important. Thirdly, there's a lot we can do in terms of the address, in terms of seeing what is the village, what are the portfolio outstanding in the village. We are doing a lot of work around the village, but you know, it's something everybody can do. So because in that sector, as we know, the lending is very social in nature. The way the village behaves is also very important to the way the individual would behave, right? Overall, I would say that doing the scorecards or giving the inputs to the scorecards in terms of this PII data, in terms of, as I said, location, in terms of gender, in terms of occupation, these are all great input variables in order to build a score towards the NTC part. So just to sum up, I spoke only on the data that's there in the bureau. There are so many things about external data, but let's focus on what we have and what we can build on what we have. So,
Right. Thanks, Aditya. My last question to the panel, and I would request any one of you to take it up. Looking ahead, what trends are you seeing as the game changer for MSE financing in India, assuming we are looking at the next 5 years? Any one of you? Yeah.
I think there are lots of trends that we should talk about. And I think when you look at this problem of micro enterprise lending, and when you typically look at the small and micro scaled enterprises, the problem is very large. There's a lot to be done. But I think let's not forget that a lot also has been done. And there, I think we can see clear trends which will support us or tailwinds which will help us. First is that we have a very solid KYC infrastructure. Everyone, when you look at a KYC, you can be almost certain that the person exists. And you can validate that digitally, either with the NSDL database or the Aadhaar database to really reconfirm. Second is that we have a solid infrastructure for payments and at a very low cost. You can have very good infrastructure. Banks have always had a very good infrastructure for payment, but that was never at a very low cost. Now we have that available. Two very big markers. We have a account aggregator which has come in where anyone who has a bank account, we can extract that information easily. We have a tremendous database of in credit bureaus, which Aditya mentioned. And thanks to the MFI industry, which has been so pervasive, we have a lot of data points to really look at. Things that really are the tailwinds which will help us. Now, what will be the trends that will solve the problem? I think gradually, people, the end customer has to understand and has to accept that they need to move up. And you can see signs of that. Many of us thought that customers would never use an ACH to pay. Today, in iFinance, we have 93% of our customers who use ACH. And I think many of the people sitting here will come up with the 90% plus number. Now, would one have thought that these unorganized players would use ACH to pay? The use of UPI is quite prevalent. I think that trend is ongoing. And I think the second thing is that people have to start seeing that we want to produce better products that can be sold not only in India but outside. That too will come. I think it's a matter of time. And I think if we start producing good quality products, good quality services, and we have the financial literacy to support those businesses, things will fall into shape. My sense is that this is the start. The wheel has started turning. In the next 5 years or maybe in 10 years, you will see a completely changed India. And I do hope so, because this is the problem that will also solve the Indian problem of unemployment and employment. Out of the 12 crore jobs in non-agri sector, almost 10 crore jobs come from the micro and small enterprises. So unless we solve this problem, we will have a problem of unemployment to tackle. And I hope that we don't have that problem to tackle in the 10 years.
Can add to that?
Yeah, sure.
See, consumer credit, now we see that there is 30% of all the new credit in consumer lending is through fintechs. SMEs all put together, we are not even at 1% of the total demand. So huge room to grow and huge challenge and space. And I think a lot of tailwinds that, Sanjay ji rightly spoke about, we have all of this, innovation, UID, UPI, account aggregator, GST, and all of that formalizing. But at the same time, I think there is also, we have seeing a lot of regulatory, structure. So moving now from innovation to responsible innovation, customer service to customer protection, and building compliance as an important factor in our costs and our business plans is very important. And I think in the long run, you got to be able to survive to be able to serve our customers. So I think it's very important as we think about creating impact, we got to keep portfolio quality healthy, we got to manage liabilities, we got to make sure we have razor sharp focus on compliances and doing the right thing so that we are able to serve our companies, build businesses better, regulatory compliant, and therefore able to serve the customers. I think that's very important as we think through the next stage of growth.
Great. Thanks, Pallavi. I think we'll conclude this session. And I would like to firstly thank all the panelists for their valuable insights. I think the key takeaway is that for unlocking the true potential of MSEs, we need a collaborative approach. I think all stakeholders in the ecosystem, including financial institutions, credit bureaus, ecosystem enablers, I think everyone has to come on board, and that's the only way to go forward. Thank you once again for your time and patience, and I look forward to some of these ideas being discussed today materialize into real actions and the real impact at the ground level. Thank you so much.
Thank you, speakers. Thank you, esteemed moderator, for such a thought-provoking and insightful and interesting discussion. Please do join us front and center for a photo op. And also, we would like to present a small token. Thank you.